Hello friends, good morning, good afternoon, good evening, whenever you're watching or listening to my channel NSR Audiobooks. Welcome back to my channel. Let's roll up to next topic. In The Psychology of Money by Morgan Housel, lessons from behavioral economics provide valuable insights into understanding and improving financial decision-making. Here's how these concepts may be explained in the book, Biases and Heuristics. Behavioral economics explores how cognitive biases and heuristics, or mental shortcuts, influence financial decisions. Housel may discuss common biases such as loss aversion, confirmation bias, anchoring, and availability heuristic, and how they can lead to irrational or suboptimal money choices. Emotional influences. The book likely addresses the emotional aspects of decision-making as highlighted by behavioral economics. Emotions such as fear, greed, overconfidence, and regret play a significant role in shaping financial behaviors, risk tolerance, and investment outcomes. Decision context. Housel may explain how the context in which decisions are made impacts financial choices. Behavioral economics studies show that framing effects, default options, social norms, and decision environment influence our financial decisions and preferences. Time preferences. Behavioral economics examines time preferences and how individuals weigh immediate gratification versus delayed rewards. Concepts like hyperbolic discounting and present bias shed light on why people may struggle with saving for the future or making long-term financial plans. Nudges and choice architecture. The book may discuss the concept of choice architecture, where subtle changes in how choices are presented, nudges, can influence decision outcomes. Behavioral economics research on nudges, defaults, and choice architecture provides strategies to encourage positive financial behaviors and improve decision-making. Behavioral finance. Housel may integrate insights from behavioral finance, which combines principles from psychology and economics to understand investor behavior and market anomalies. Topics such as herd behavior, market bubbles, irrational exuberance, and risk perception are explored within the context of behavioral economics. In The Psychology of Money by Morgan Housel, biases and heuristics play a significant role in shaping financial decision-making. Here's how these concepts may be explained in the book. Biases. Confirmation bias. This bias refers to the tendency to seek out information that confirms our existing beliefs or opinions while ignoring contradictory evidence. In the context of money, people may selectively interpret financial news or data that aligns with their investment decisions, leading to potential blind spots and missed opportunities. Loss aversion. Loss aversion is the tendency to strongly prefer avoiding losses over acquiring equivalent gains. Housel may discuss how this bias can influence risk tolerance and investment decisions, as individuals may be more averse to taking risks that could result in losses, even if the potential gains outweigh the losses. Anchoring bias. Anchoring bias involves relying too heavily on the first piece of information encountered, the anchor, when making subsequent decisions. In financial contexts, anchoring can influence perceptions of value, pricing, and investment evaluations based on initial reference points or market cues. Overconfidence bias. This bias refers to individuals' tendency to overestimate their own abilities, knowledge, or predictive accuracy. Housel may explore how overconfidence can lead to excessive risk-taking, speculative behavior, and unrealistic expectations about investment outcomes. Heuristics. Availability heuristic. The availability heuristic is a mental shortcut where people make judgments or decisions based on readily available information or examples that come to mind easily. In finance, this can lead to biased perceptions of risks or probabilities based on recent or vivid experiences, media coverage, or memorable events. Representativeness heuristic. This heuristic involves categorizing or classifying information based on how closely it resembles a typical or representative example. Housel may discuss how representativeness can lead to stereotyping in investment decisions, such as assuming that past performance of a stock or asset will continue in a predictable pattern. Framing effect. The framing effect refers to how the presentation or framing of information can influence decision-making. Different ways of presenting the same information can lead to different decisions. For example, framing an investment as having a 90% success rate versus a 10% failure rate can evoke different reactions, even though the information is equivalent. In The Psychology of Money by Morgan Housel, emotional influences play a significant role in shaping financial behaviors, decisions, and outcomes. Here's how these concepts may be explained in the book. Fear and anxiety. Housel may discuss how fear and anxiety can drive financial decisions. Fear of loss, market volatility, economic uncertainty, or financial setbacks can lead to risk aversion, panic selling, or avoidance of investment opportunities. Understanding and managing fear is essential for maintaining a balanced and rational approach to money management. Greed and overconfidence. The book likely addresses how greed and overconfidence can impact financial decision-making. Overestimating one's ability to predict market trends, chasing high returns without considering risks, or succumbing to the allure of quick gains can lead to impulsive or speculative behaviors that may result in financial losses. Regret and loss aversion. Housel may explore how the fear of regret and loss aversion influence decisions. People often avoid actions that may lead to potential losses or regret, even if those actions have the potential for greater long-term benefits. Loss aversion can lead to conservative investment strategies or holding on to losing investments longer than necessary. Happiness and contentment. The book may also highlight how emotions like happiness, contentment, and satisfaction can impact financial well-being. Feeling financially secure, achieving financial goals, and aligning spending with values can contribute to a sense of happiness and fulfillment. Conversely, financial stress, debt, or inadequate savings can negatively impact emotional well-being. Emotional resilience. Housel may discuss the importance of emotional resilience in managing money. Building resilience involves developing coping strategies, staying calm during market fluctuations, avoiding impulsive decisions driven by emotions, and maintaining a long-term perspective despite short-term challenges. Impact on relationships. Emotional influences extend to financial relationships and interpersonal dynamics. Housel may explore how money-related emotions such as trust, envy, generosity, or guilt can affect relationships with partners, family members, or colleagues. Effective communication, empathy, and understanding of each other's money attitudes and emotions are essential for healthy financial relationships. In The Psychology of Money by Morgan Housel, the concept of decision context is explored as a crucial factor that influences financial decision-making. Here's how this concept may be explained in the book. Framing effects. Decision context refers to how information is presented or framed, which can significantly impact decision outcomes. Housel may discuss framing effects, where the way choices or options are framed can lead to different decisions. For example, framing an investment as having a 90% success rate versus a 10% failure rate can evoke different responses, even though the information is equivalent. Default options. The book may address how default options within decision contexts can influence choices. Default options are preset choices that individuals accept if they do not actively make a decision. Housel may discuss how default options in retirement plans, savings accounts, or investment platforms can shape financial behaviors and outcomes. Social norms. Decision context also includes social norms and cultural influences that affect financial decisions. Housel may explore how societal expectations, peer pressure, family traditions, and cultural values impact money-related behaviors, goals, and attitudes. Information presentation. The way information is presented within decision contexts can impact perceptions of risk, reward, and opportunity. Housel may discuss how visual representations, data visualization, graphs, charts, and narratives influence decision-making processes by making information more accessible, understandable, and persuasive. Decision environment. The book likely addresses how the decision environment, including timing, setting, and external factors, affects financial choices. For example, market conditions, economic trends, political events, and personal circumstances create different decision contexts that influence investment strategies, risk assessments, and financial goals. Cognitive load. Decision context also considers the cognitive load or mental effort required to process information and make decisions within specific contexts. Housel may explore how cognitive biases, information overload, decision fatigue, and limited attention spans impact decision quality and outcomes. In The Psychology of Money by Morgan Housel, time preferences refer to the way individuals value present versus future outcomes and how this preference influences financial decisions. Here's how these concepts may be explained in the book. Present bias. Housel may discuss present bias, where individuals tend to prioritize immediate rewards or gratification over long-term benefits. This bias can lead to behaviors like overspending, neglecting savings, or making impulsive financial decisions that prioritize short-term gains but may have negative consequences in the future. Delayed gratification. The book likely explores the concept of delayed gratification, which involves foregoing immediate rewards in favor of larger, long-term benefits. Housel may highlight how cultivating the ability to delay gratification is crucial for achieving financial goals, building wealth, and maintaining financial discipline. Time horizon. Time preferences also consider an individual's time horizon for financial planning and decision-making. Housel may discuss how a longer time horizon often leads to more patient, strategic investment strategies, while a shorter time horizon may result in riskier, short-term focused decisions. Hyperbolic discounting. Housel may explain hyperbolic discounting, which is the tendency to value immediate rewards more highly than future rewards, but the value of those future rewards increases as the future approaches. This can lead to inconsistent decision-making, where individuals may choose smaller, immediate rewards over larger, delayed rewards, even if the latter would be more beneficial in the long run. Goal setting. Time preferences are closely tied to goal setting and planning for the future. Housel may discuss how aligning financial goals with time preferences is essential for creating effective saving, investment, and retirement strategies. Individuals with a long-term time horizon are more likely to engage in behaviors that lead to financial security and wealth accumulation. Financial patience. The book likely emphasizes the importance of financial patience in managing time preferences. Developing patience involves resisting impulses, controlling spending, avoiding debt, and staying committed to long-term financial goals, despite short-term temptations or setbacks. In The Psychology of Money by Morgan Housel, nudges and choice architecture are concepts from behavioral economics that play a significant role in influencing financial decisions. Here's how these concepts may be explained in the book. Nudges. Housel may discuss nudges as subtle interventions or prompts that influence behavior without restricting choices or mandating specific actions. Nudges are designed to steer individuals towards making better decisions without removing their freedom of choice. Examples of nudges in the context of money management could include setting default options for retirement savings plans, e.g., automatically enrolling employees in a savings plan with an opt-out option, providing personalized feedback on spending habits, or using visual cues to encourage desired financial behaviors. Choice architecture. Choice architecture refers to the design of decision-making environments that influence choices by structuring how options are presented. Housel may explain how the way choices are framed, organized, and displayed can impact decision outcomes. For instance, organizing investment options from least risky to most risky can influence risk perception and investment choices. Similarly, highlighting certain features or benefits of financial products can affect preferences and decisions. Behavioral insights. The book likely explores how nudges and choice architecture leverage behavioral insights to encourage positive financial behaviors. By understanding cognitive biases, decision-making heuristics, and psychological factors, designers can create nudges that align with human tendencies and promote better financial outcomes. Housel may discuss how nudges can address common behavioral challenges such as procrastination, inertia, cognitive overload, and decision fatigue, making it easier for individuals to make informed, beneficial financial decisions. Implementation in financial services. Housel may provide examples of how nudges and choice architecture are implemented in financial services, such as using prompts to encourage regular savings contributions, simplifying investment options to reduce decision complexity, or framing information in ways that enhance understanding and engagement. These strategies can help individuals overcome barriers to financial planning, increase participation in savings and investment programs, and improve overall financial well-being. In The Psychology of Money by Morgan Housel, behavioral finance is a key concept that delves into how psychological factors influence financial markets, investor behavior, and decision-making. Here's how this concept may be explained in the book. Market anomalies. Behavioral finance explores market anomalies that cannot be explained by traditional financial theories. Housel may discuss phenomena like market bubbles, irrational exuberance, stock market crashes, and asset price fluctuations driven by psychological factors rather than fundamental economic principles. Herd behavior. The book likely addresses herd behavior, where individuals tend to follow the actions of the majority or consensus, leading to market trends and momentum. Housel may explore how herd behavior can create market inefficiencies, speculative bubbles, and exaggerated price movements based on collective emotions and actions rather than rational analysis. Risk perception. Behavioral finance examines how people perceive and assess risk, often influenced by cognitive biases and emotions. Housel may discuss concepts like risk aversion, loss aversion, ambiguity aversion, and perception of probabilities, showing how these factors impact investment decisions, asset allocation, and risk management strategies. Overreaction and underreaction. The book may discuss tendencies of investors to overreact or underreact to new information or market events. Behavioral finance studies show that investors may overreact to negative news, causing market sell-offs or undervaluation of assets, while also underreacting to positive news, leading to delayed market adjustments and missed opportunities. Biased decision-making. Housel may explore various cognitive biases that affect investor decision-making, such as confirmation bias, anchoring bias, availability heuristic, and recency bias. These biases can lead to suboptimal investment choices, market inefficiencies, and deviations from rational, efficient market behavior predicted by traditional finance theories. Investor psychology. Behavioral finance also considers investor psychology, emotions, and behavioral traits that influence financial decisions. Housel may discuss psychological factors like overconfidence, regret aversion, framing effects, mental accounting, and self-control issues that impact investment behavior and outcomes. Overall, the psychology of money likely integrates insights from behavioral finance to explain how psychological factors drive market dynamics, investor behavior, and financial outcomes. Understanding these concepts helps investors make more informed, rational decisions, navigate market uncertainties, and build resilient investment portfolios.